It's nice to meet you all. Nice to see some familiar faces. For those of you I haven't met, my name is David Conroy. I'm the Director of Emerging Technology at the National Association of Realtors. So a kind of 100-year-old organization, very traditional business. I get to work in the emerging tech side of things, so it's my job to look 5, 7, 10 years out at any new technology that could potentially impact a real estate transaction and do deep dives. And because I had that opportunity, I've actually been looking at crypto since about 2013. That's when I first got into mining Bitcoin. So I know what you're thinking. No, I sold all those Bitcoin way too early. Otherwise, I'd be up here in a nicer suit. But again, I've been researching applications for blockchain and real estate since about 2015. At one point, I got so obsessed with it, I actually quit my job at NAR. And I moved to New York to work at Consensus, where I tried to start a startup tokenizing some townhomes in Brooklyn. Since then, a lot of things have changed. We were very early, but I've always tried to stay up to speed on blockchain and crypto and real estate. But I'm very glad to be joined here with Chris, who is more in the day-to-day of crypto and real estate. So really thrilled to have the discussion. Thanks again for having us.
Yeah, thanks, Dave. Hey, everyone. Thanks for coming out. So my name is Chris Lehman. I'm one of the co-founders at Groma. Groma is a Boston-based real estate and fintech company. Our ultimate goal is to run and build a real estate-backed cryptocurrency. Obviously, there are a lot of steps that have to happen along the way. The world isn't actually there yet. Network effects being kind of the primary one. You can't actually have something that works as a currency without having millions, honestly, really hundreds of millions of users. But in the medium term, we have a lot of other goals, like expanding access to real estate wealth building through fractionalization of real estate assets on the blockchain. So today, we have a portfolio of around 200 million worth of real estate assets around the Boston area. We have the actual individual properties denominated as NFTs, and then issue REIT shares as fungible ERC20 tokens, providing better transparency, better access, better liquidity. There is obviously, as you can probably guess, some regulatory hurdles there, both on the securities side and on the housing policy side, and we're working on a lot of that, but the model's built to work under the current regulatory regime and then scale and work with government as government stances evolve on these things as well.
Cool. I know we had a pre-call and we've spoken a couple times before this. I actually wasn't aware of what your opening line there was. You're actually looking to launch a currency.
That's right.
That's backed by real estate. Very, very ambitious.
Yeah, so and I can talk a little bit more about why we would want to do that, right? And there's a lot of different reasons, lots of different answers for why you might want to do that. Part of this is, real estate is one of the largest asset classes in the world, right? Residential real estate alone is 47 trillion in the United States. It's hundreds of trillions worldwide. Not only that, it's something where transaction costs in traditional systems are pretty high. And this is obviously one of the big appeals of blockchain in general. So it's something that should apply well to real estate. But then more philosophically, thinking about what a currency is, how you would go about designing a currency if you had to do so from scratch, from first principles, you would want to think about what are the ultimate sources of value in society, how do economies work, what are the inputs to growth and development in an economy, and really there aren't many things that work as well as real estate for that in the modern economy. You could say energy, you could say processing power, but I could go on for a long time here, but we've got a lot of other questions we can get to too.
Yeah, no, it's great. I feel like I know you a lot more already. I thought we were being ambitious just trying to tokenize homes, let alone launch a whole currency. I guess for the benefit of the audience who might not follow this stuff day to day, can you give us just like a rundown on the current state of tokenizing real world assets like real estate on blockchain? Like where are we at today?
Yeah, absolutely. So there's a lot of different projects going on right now, both in the public and private sectors. In the private sector, obviously Groma, which we'll talk some more about. Some other examples, Roofstock on-chain is a sub-project of Roofstock, which you may be familiar with. It's a investment company for investment in the single-family rental space, making it easier to trade in those assets, which have obviously been very popular over the last decade, maybe not quite decade and a half. And so the on-chain project enables people to do so with NFTs as the actual denotation of that asset. Other ones, Centrifuge is a platform that a lot of you may be familiar with in the blockchain space, using real estate assets on-chain, allowing lending. based off of that. And so real estate works really well as a source of collateral and for yield on the debt that centrifuge issues. Public sector, obviously Lugano is doing some work on this. The Bank of England is investigating the use of blockchain to eliminate the need for escrow in real estate transactions. There's some work going on here in Massachusetts. I don't know if you've seen the speeches from Reps Kate Lipper-Garabedian and Josh Cutler, who are working on deed registry legislation. There are also some projects going on at the county level on that. And then, Groma, of course, has its own plans.
Yeah. The National Association of Realtors also has an investment arm called Second Century Ventures. And back in 2017, 2018, we made some blockchain plays as well. You might have heard of Proppy before. They were like one of the first companies that did NFT sales for real estate assets in Florida last year. But like you said, there's a lot of people working on this, public, private. I have a lot of crypto zealots telling me like this is going to totally change the real estate industry. But everything just seems, in real estate and in crypto, both markets, both things seem so unpredictable. Like, do you think that this is going to lead to major issues if the unpredictability of crypto meets the housing market or housing bubbles? Like, why is it a good idea to combine these two things?
Yeah, definitely. No, and worth noting that there are independent sources of volatility in both crypto and in real estate, right? Obviously, we've seen the 2008 crisis in real estate. We saw the pandemic in real estate, both of those hugely disruptive. Crypto honestly has an issue with volatility in terms of its overall brand, but it's worth thinking about what are the sources of that volatility, right? And with a lot of, I think, more traditional crypto assets that aren't backed by hard, well-understood assets, a lot of the volatility just comes from an inability to effectively and rigorously model what should a Bitcoin be worth, what should ETH be worth. There's just not an established way to do that. People have all kinds of heuristics that they kind of rely on, but they're not well agreed upon. There's lots of variation, there's lots of regulatory risk. And so if you're dealing then with crypto assets that are backed by real world assets like real estate, you wouldn't necessarily expect there to be enduring volatility just by the virtue of it being denominated on blockchain as well.
I've got more doomsday questions. We'll save those for later, though. So I've got more questions about trust and smart contracts and how automation is going to work. But before we get to those, I think it would be good if you explain just exactly kind of how Groma works. So when I'm asking you these questions,
for sure,
they've got some context. So what is Groma's business model today? What's on chain today? Like, how close are we to actually having assets in Boston, where you could look up on Etherscan? Like, where are we there?
Right, definitely. So currently, you can actually look at our assets on chain. So as I said, Groma has a portfolio of 50-ish properties around Boston, total value of around 200 million at this point. You can go on our website, you can look at different properties, different funds, and see the actual Ethereum architecture that's behind them. But I guess that's a narrow answer to one of your questions. I think more broadly, talking about Groma's business path and how we want to make sure that the business is scalable at each point. Right now, we're basically a real estate company. We have a lot going on in the background, working on the blockchain solutions, working on the regulatory approval, but the day-to-day of the company right now is really very similar to what you'd expect from a traditional real estate company, both on the investment and the property management side.
So would it be fair to say that traditional real estate business is almost like subsidizing the R&D to get where you want to go?
Yeah, that's a reasonable characterization. Depending on how you look at it, right? There are multiple companies that fall under the Groma ecosystem, so it's kind of a PropCo-OpCo model, right? And so the PropCo, the REIT, doesn't actually pay for any of our software engineers, for our design and branding team. Those are really come from the pure startup model, right? VC dollars, money from some of our founders, right? Those are what are actually paying for our long-term R&D so that it doesn't eat into the actual performance of the assets.
Got it. So you said you got 50 properties, about 200 million or so all around Boston. It's in a tokenized REIT that is on chain.
Yes.
And that, can anyone get access to this, or you have to be a certain level investor? Where are you at with the Reg D, Reg CF?
Right, definitely, yeah. So a few comments on that. So one, just making it clear what is going on in terms of both the blockchain assets and the actual securities. We essentially have parallel systems both for the individual properties and for the securities that represent REIT shares. So we have, for a given triple decker in our portfolio, which is most of the actual assets, we have the deed registered with the normal deed registry in Suffolk County or whichever other county the property's in, and then in parallel we have an NFT representing that. Similarly for the REIT, we have the REIT shares that are recorded and stored with the transfer agent, and we also have the ERC20 tokens that are parallel to those transfer agent records. So long term, we would love for the blockchain to serve as the actual legal source of truth. We're obviously not there yet in terms of where the SEC is, but we'd like to move towards that eventually. And then the, sorry, what was the other part of the question?
I was just trying to, get everyone up to speed on like where exactly are we with real estate assets on chain. You mentioned you've got, you're doing just, double entry for now. You're doing traditional real estate with recorders of deeds, and then you're also trying to, essentially establish standards for how this would be done on chain. You mentioned that you've got ERC20s and you've got NFTs. Like, how does that actually get you access to the value of the property?
Oh, right. I remember the other part of the question now. It's the regulatory side of things, right? And who's actually allowed to buy these things. So we're going through the full normal securities process, right? So as of May, we entered into Reg D 506C, which enables us to do general solicitation only for accredited investors. So we've been in that for a while. We've actually raised most of our money prior to that just through general back channel networking. But we expect at some point this fall to be under Reg CF, which enables us to raise money from anyone. So that's still has a cap of $5 million annually in terms of fundraising. We would then transfer from that.
Per asset?
Sorry?
Would that be per asset that you fundraise?
No, we would be fundraising for the REIT in general. So all of this is referring to the REIT as a pool, and so as money comes in, we use it, based on our judgment to acquire individual assets. We would then transition from Reg CF to Reg A+, which boosts the limit up to $75 million annually, and then eventually an S11, which is basically being fully public in terms of our ability to raise money, though of course there's increasing levels of regulatory audits and approval for each of those successive stages.
So, in full transparency, that's kind of what killed my blockchain startup in 2018, right? The regulatory uncertainty, it was so, the waters were so muddy, we didn't know if we needed a broker-dealer license, we didn't know if we needed a money transmitter license. We had all of these assets that we were tokenizing that if I were on a stage like this back then, I couldn't even talk about them because of all the regulatory issues. So it's good to hear that that's getting a little bit easier.
Well, I wouldn't say it's getting easier. We think we're going to do it, but we have had to spend a lot of time and money to do it, both because just the basic systems, leaving crypto out of it, are pretty high barriers to entry in terms of the amount of time and money you need to spend getting these approvals. And then especially when you're talking with the SEC and you're going through that review process, if the word blockchain's in there, they're going to have a lot more questions. And we're very good at answering the questions, and they haven't had a negative stance. They just, for the reasons that we're probably all aware of, have really high level of nervousness with any of these things. And so we've done a good job talking with them about this. We have a counsel externally who used to be fairly high up at the SEC, so we can do this, but unfortunately it takes a lot of money, and without the kind of financial backing that we have as a startup, it would probably be prohibitively expensive.
And you said the investors in Groma are just comfortable with that risk versus just wanting a more standard return from a traditional real estate business?
Correct. And so again, there's two different types of investors, right? There's REIT investors who want kind of the stable income and steady appreciation of real estate, and then there's also startup investors, right? VCs who want, who have the appetite for higher risk, essentially.
And that would be in Groma as opposed to the REIT.
Exactly. Groma Corp versus Groma REIT.
Gotcha. So one of the things that really attracted me to blockchain and crypto was smart contracts. Like going back to 2015, I was creating ERC20 tokens with my street address on it and fractionalizing them and trading them. And I thought, wow, this could impact the real estate transaction itself so much if we were able to automate and log and record all of these things on chain. I've heard that you're using token contracts. Are there any other smart contract uses that Groma is currently using or have planning?
Currently no, but in the near future, what we think one of the killer apps for the actual Groma REIT tokens, which we call Groma coins, is going to be what we call the liquid mortgage, which is basically a way for renters to build wealth gradually in real estate equity without having to spend additional money on top of their typical rent payments. And I can go in detail on how this would work, but basically, this is not only a way that we can grow our ecosystem and scale the company, but it's a way to address via financial innovation some of the problems that we're probably all familiar with in terms of how housing works today, right? People being priced out of home ownership, people being faced with increasing rents that cut into their standard of living. There's a lot of problems on the housing and land use policy level that have created these problems. And while we do advocacy, and that's a lot of my job, on trying to reform housing policy itself, we also want to work on our own to develop solutions that make it easier for people to build incremental wealth there.
Chris, it's a good thing that Justin put the two of us on stage together, because when it comes to advocacy, that's like one of the main things the National Association of Realtors does. Like, the reason you can use DocuSign to buy a home today is because NARs work on the Hill. So we should maybe talk more after this.
Probably, yeah.
All right, so liquid mortgage, can you, we talked about that just for a second there. When I hear that term, I think like, all right, is this something that I've staked somewhere that I can get, yield on it somewhere else? Is this some type of streaming payment system? What is a liquid mortgage?
Yeah, good question. So it does involve effectively staking. Basically, the way it would work is, suppose you're a renter, suppose you're paying, let's say, $2,000 a month on rent. Instead of taking that $2,000 and giving it directly to your landlord in exchange for living space, take the $2,000, purchase $2,000 worth of Groma coins, the REIT shares. You now own those REIT shares, but you haven't paid for your rent yet.
Okay.
So what you would then do is borrow either from Groma or more likely from one of our external lending partners an equivalent amount of money, $2,000, secured against your new asset that you own. Use that to pay your landlord. So at this point, you have an asset worth $2,000, the Groma coin, and you have $2,000 worth of debt because you've had to take out a loan to pay your landlord.
Yeah.
You're at net zero, but over the course of the next month, three things will happen. One, of course, you have interest that you have to pay on that debt. But on the other hand, you have dividends that are being paid out by the Groma REIT based off of the rental income produced by those properties, and you have appreciation of the underlying assets. And so,
even if it's just a property you're renting?
Sorry?
Even if it's just a property you're renting?
So it would not have to be the property you're renting. This is something that would definitely be available for renters at Groma properties, but you could live, in California, where Groma currently doesn't own anything, and be a renter and still engage in the same program, owning fractional shares of income-generating residential properties in the Boston area. And so over time, and we've done the math on this, we've done the historical research, the vast majority of time, the sum of the expected dividends and appreciation, and obviously there are no guarantees, there's variability, et cetera, but the vast majority of the time, the dividends and the appreciation together significantly outweigh the interest, so you're actually building net worth in real estate assets without having to cut into your existing spending, whether it's on rent, food, insurance, any of your other expenses, which over time can be a really powerful tool for renters who have found it hard to, say, save up for a down payment.
Gotcha. So liquid mortgage is more of like the crypto definition of liquid, as opposed to an asset that's easily sellable.
So you would, it's honestly both, right? Because you would own Groma REIT shares, which, while again we're not in Reg CF yet, they aren't really fully liquid. They will eventually be exchange tradable. And so conceivably at any point, let's say you've done it for a few years, you've built up a net profit of, let's call it $10,000, and you have pretty significant gross equity and gross debts, you can take the assets that you built out and cash out at any point, right? So it's liquid in both senses.
Gotcha. Wow, it's a bit of a mind-bending conversation there.
It's easier when I have slides and images to go along with it, which we'll be releasing soon.
Back to basics for a second. What other smart contract uses should there be, or have you seen in real estate? I'm shocked that we haven't seen like a way for somebody to just put down their escrow payment with a crypto, or pay their rent with crypto. Like, why doesn't that exist? Would you accept crypto for rent in one of your 50 properties?
We probably would. I mean, just because of how our model works and because of what we would have to do with that money, we would probably have to convert it into dollars or convert it into something like USDC pretty quickly, because the money has to then be funneled into, repairs, maintenance, acquisitions, all of these other things that, the payment infrastructure for actual crypto doesn't exist yet. We're pushing for that to happen, and we've talked with people at Circle, talked with people at Fidelity about ways that the system could eventually evolve over time to accommodate that. But yeah, we could definitely do accepting payments in Circle in USDC and then convert it into actual dollars.
What else? Now that again, another thing that really got me into blockchain early on was just like the composability, right? So great, you've represented a real world asset on chain. Now, there should be some pretty incredible financial tools you can do with that, in addition to the liquid mortgage.
Yeah.
What other smart contract-based derivatives do you think will come from actually being able to represent a house on chain?
Yeah, so conceivably there are all kinds of different things you could do here, and a lot of it will really depend on the government agencies that deal with the real estate industry, right? There are all kinds of bottlenecks that limit the rate at which these transactions can happen, that impose additional costs, which in turn decreases the efficiency of the market as a whole. And so a lot of these things are gated by various parts of government that, as we know, tend to be a bit slower to adopt things. Obviously, there's variation. We've seen, in previous panels, people who represent governments that are more innovative, but we're still in early stages, and we'd love to see some innovation there that makes things lower transaction cost, more liquid, resulting in more efficient asset allocation.
Right, so do you see a world where in the future, like instead of home sale listings going out to something like an MLS, all of a sudden it's some like NFT marketplace where homes are being traded in a decentralized manner without a real estate professional in the middle?
You absolutely could, but that's not to say that there wouldn't be opportunities for people who have that deep knowledge of the real estate economy to take advantage of that dynamic, right? It might be in a somewhat different role, but I'm sure people like you and other people who are forward-looking in that industry would have the opportunity to build businesses around driving people towards more efficient trading patterns and other businesses built on top of that platform.
Gotcha. So our 1.5 million realtors, we're safe still.
Yeah.
Wonderful. Let's pull on that thread a little bit more, though, right? So, in a world where homes are, you're able to list them for low fee, trade them, in seconds instead of weeks. Who are the real winners there, and who are the real losers there in that world?
Yeah, good question. So, for sure, no question, a huge winner are just the people who actually live in these assets, right? A big theme we're working on at Groma, and kind of a key concept behind the idea of the liquid mortgage, is the idea that there's no real logical necessity that the house that you live in has to also be a house that you own. That's typically how it works, and a lot of that has been because information transmission has been really inefficient up until the past few decades. But conceivably, you might want to live, let's say, in somewhere on Cape Cod, right? You love it there, you love the quality of life, you love the ocean, etc. But you really don't necessarily believe in the appreciation and the investment quality of a house in Cape Cod. You'd rather invest in, say, Miami, or maybe somewhere outside of the United States. Conceivably, you could own assets in places where you expect the financial performance over time to be optimal, and then use some of the proceeds from that to cover the cost of your living space in the place where you actually prefer the quality of life, or proximity to jobs, etc. So that's one big winner, right? The people who actually consume housing. And then thinking more about the people who are in the industry, right, and who are making profits off of these transactions and adding value along the way, I think there's a real parallel here to be made with the rise of software in general in the later decades of the 20th century, right? Lots of people thought that the introduction of programs like Microsoft Excel or other types of financial databases would be a bloodbath for bookkeepers, right? People can do these things much more efficiently, and so you need way fewer of those people to actually handle all of that work. Whereas in reality, we saw the opposite happen, right? Because the cost of those kinds of services was decreased so much by the introduction of these technologies, the actual demand for those services massively increased, right? And the different places in the economy where those services became viable grew so much that we have way more people like that today. And right, and the U.S. economy and economies in other parts of the developed world, even the developing world, have seen massive growth in that financial services sector.
We've got about 2 minutes left here. So I generally agree with everything you said and where this is going. But who should be leading the way, right? Is it traditional organizations like NAR? Is it young, scrappy startups? Is it innovators? Is it disruptors? I kind of feel like you need both sides to be at the table if this is going to work. Like, how do you make sure those incentives are aligned? And how do we get from 0 to 1? I mean, you might argue that you're already at 1, but
we're not quite there yet. No, you're totally right that it's not either or. It's definitely both. You don't want to be prescriptive. You don't want to say, hey, it should look like this, and nobody's smart enough or has enough data to actually predict that confidently. And if you tried to, you would end up, cutting out viable ways to do things. So yeah, there's tons of innovation that comes from the flexibility of startups, but startups like Groma are constantly looking for larger institutional partners that can, scale up our growth more quickly and that are, smart enough and, not too hidebound such that they can adopt these technologies and apply them on a much larger scale. So both is absolutely the answer there.
One final question, and then maybe I'll sneak in a doomsday question after that. What's the biggest blockers right now?
Biggest blockers right now for Groma or for real estate in general?
For the advancement of real estate technology and transactions and getting more real estate assets recognized on chain or represented on chain.
Yeah. I mean, really, we just need laws to change. Both at the state and local level, but also obviously at the federal level, right? The SEC as a whole, though obviously there are individual commissioners who differ from this, has been pretty hostile and skeptical towards crypto in general, and there are other people in the federal government who share that stance. There are also great advocates, Jake Auchincloss from MA, Tom Emmer from Minnesota. There are people and there's momentum, Hester Peirce obviously on the SEC, to change these rules, but it's going to take really consistent pressure and making it clear to these policymakers that there is a constituency, that these things aren't just abstractions and toys for tech nerds. They're things that can actually make real difference for everyday Americans and everyday people around the world.
Nice. All right, that's it for time. Does anyone have any questions in the audience? Go ahead, sir. Oh, the one doomsday thing. When I think about in the future, say there's thousands of homes in Boston represented on chain and available for auction, is that someone just coming in with sophisticated tools like flash loans, borrowing hundreds of $millions in seconds, as long as you can pay it back at the end of it, and just tanking entire markets? Like, I'm not sure exposing the real estate industry to these shadowy supercoders won't have some negative side effects.
Right, yeah. You always have to be on the watch for that kind of thing, but at the same time...
Do you do scenario planning for that at Groma? Like, what happens if...
We do. We have annual wargaming that I host, and we come up with all kinds of scenarios, right, both on the crypto and the tech side, hackers, et cetera, also on the policy threat side, environmental threats, all kinds of things. I mean, one fortunate element of doing this in the real estate industry is the total volume of asset value is large enough that you would really need an enormous amount of coordinated effort to try to do that. And so it doesn't mean it's something that's not worth thinking about and being prepared for, but it's not something that is plausible in the near future.
Easier to steal an NFT than an actual physical building.
For sure.
Question. Are we done? We're done. All right, thank you so much, everybody.
You can catch up after. Yeah, thanks.